So just following on from where you sort of left off in the previous video, we've just shown you an example of driving price. So this is our wick here. We created that. That was something that we artificially, in this case, on the simulation, we were the driver of this wick down. Now, if we that was only with 60 or 1200. I'm still actually short the contracts at the moment. So that was with 1200, 1,233 contracts. So yes, it's a considerably large position. It's a very large position. You know, OTE, you're talking $6 per tick in the currency futures. So $6 times 1,233, you're looking at sort of $7,000 per price movement. So it's considerable. And when you look at the price movement that we had here, from 23.80s to 24.14s, that's 34 ticks of price movement. It's a large enough price movement for $7,000 per tick, to either make or break. However, when we always need to consider that there are institutions and there are commercials and banks and hedge funds and very large traders and trading desks that will happily trade at large volumes because they're mandated to, you know, and continue to trade at large volumes. So to have any real influence, there's no real, you know, you can have large traders. So I've spoke with and I've worked with very large traders, specifically in the bond markets, who would trade 1,000 lot clips, and even in the Schatz in the German 2 year government bond market, um, the guy on the trading floor was trading 10,000 lots, in one clip. The market could handle that. The bond market is very, the longer term the bond, the more uncertainty, so the more illiquid the the depth of the market becomes on the price ladder. So the 2 years is a fairly stable market, and you can have 5 to 10,000 contracts per price. So it's all relative to what the actual market is that you're currently trading. But having large size and using large size, they're very different things. So 1,200 contracts that we've just traded, we obviously moved the price 34 pips, as we just spoke about. How can we, if we were a large institution, we in theory, depending on our book and how much we need to fill and the orders we need to fill, if we're filling client orders, for example, the client may say, um, take JP Morgan or Goldman Sachs or any investment company, investment bank, we may have a client order to fill um, $1 billion, for example, and in which case that's going to it will take a large amount of volume to fill the order. So what will happen is, and we can make an example of that on the buy side, irrespective of the loss that we'll take for, for for the position size, um, but ultimately what we'll have is a consistent flow of orders supporting or driving the market rather than this wick. So we traded a large amount of volume at a very condensed area of price. But what we can do now is, as I say, we're an investment bank. We have $1 billion to fill for a client. We can drive price, so we can watch what we do to the price here on the right. So we're filling orders here. Wait for those to fill, and then we may decide to fill another order, and then another order, and then another order, and we may continue to just drive the price higher when the liquidity returns back to the market and keep filling orders higher, pushing through daily highs, pushing through uh, stops as well. And at some point, we will see the this will return back to the if I pull all these orders, this will return back to where we were trading because we were artificially driving price. So it's going to return back to where it's trading in real time. But if we were the bank doing that, then the price would absolutely continue to be supported and the price would continually drive higher. And what we see is as the price goes higher and as we trade through, for example, the current day highs, we have resting orders. So we have breakout traders. Everyone seeing that when the market reacts to um, breaking through a high, we have the traders coming in and buying the market as well. So adding fuel to that fire. So we're now, I didn't mean to do that. We're now supported or joined by more buyers. And we also then have stop losses. So we see stop losses that will be traded through. Things like double tops, uh, daily highs, old daily highs, weekly highs, monthly highs, things like that. They all pose as liquidity. There's there's buy stops above old highs. So when we trade through those, we have even more buy side liquidity coming in. So that's why we just need to find a scenario here of buy side. This is why we see things like this because we have a lack of liquidity. We trade through certain prices. Somebody's driven price higher here, fueled by a bank, say, filling a large client order, fueled also by um, stop stop losses being triggered, breakout traders joining the market. At the same time, however, that order is being filled by someone. The liquidity is extremely thin on the offer. So as we're trading higher and higher and higher, the liquidity on the offer is dropping off because we're taking that liquidity. The sellers are becoming more reluctant to sell because their orders are being filled. So once the seller's orders are filled, the next seller may be 50 pips higher, and in which case we'll have another jump because everyone's fighting for that liquidity to fill the bids, which is why we see things like this. And we see on the flip side, like what we just demonstrated, we see things like this as well. That they're reaching for the liquidity. In this case, it was obviously to the downside. So the sellers were reaching for the liquidity in the form of bids. We also had potentially breakout traders. We potentially had stop losses being hit. All these things add to the momentum, shall we say, in a price movement. It's the sustained price movement that is where we find our entries, not for a momentum aspect or a breakout aspect, but more for a fair trade aspect, which is why we see in my videos and my pictures, I'm constantly highlighting the areas of unfair auctions, um, and that is ultimately what these large moves are. These large moves. So even on the daily time frames, um, where we have something like this, we have a huge grab where the sellers are searching or grabbing the buyer's liquidity. So not only do we have a reason for sellers to be coming into the market, we have bad news coming out from the COVID. We have, you know, a book filled extremely long. Prior to this, the book was heavily long. So we had to have people taking off longs. And obviously to take a long off, you need to sell that long and sell to another bid. So moves like this happen because of the lack of liquidity in in the market in the particular order book. So if we open up the S&P chart in June, I think, yeah, June, and we can see we had the same scenario here. So we're bid, these are relatively large prior to the move down. These are relatively busy trading days. They're fairly substantial. As you can see, these are large swings that we're seeing in the S&P futures. All of a sudden, we have this huge injection of volatility, and that volatility comes from the lack of liquidity, as I'm about to show you, as we've already discussed in the book. So the S&P has thinned right down. So it's a heavily long market. There's a lot of long positions. Equally, there are um, short positions. For every long position, there has to be a short position. Um, the market is in theory constantly balanced in that aspect. But what we have is anyone that is long here is required to, not necessarily required, but anticipating obviously or seeing drops like this, locking in profits. Um, and locking in profits from a long trade means obviously selling back to the market. But if there's constant reason to not be long the market, then the liquidity dries up. This is what we have here. We have a very thin bid. So if we're long 10,000 contracts in the S&P and the market starts to drop, we need to close our 10,000 contracts. How do we do that? We need to sell back to the market. But by doing so, when the market's dried up and there's no bids in the market, imagine filling even 1,000 contracts in a market like this. And this is what adds to the exponential moves that we see here in price, and also the large swings that we have um, on particular days. So when people refer to the US stock market being we're back into a bull market territory, um, it's all subjective because that could change if we take a look at the liquidity on the ladder. That could change at the flip of a coin. If somebody decides to, or if somebody has the reason to sell a large order, right now the market could be in a bear market by the end of the day. It's all sort of irrelevant looking at whether we're in a bull market or a bear market because of the liquidity we have at the moment. If liquidity was a constant, it may be more reliable. If liquidity constantly sat at 3,000 on the bids and 3,000 on the offers at each price, there may be some substance behind we're in a bull market or a bear market because the conditions haven't changed. But because the conditions have changed drastically, there was a time when the S&P had two to 3,000 contracts on each price. Then we dropped and we saw sort of less than 1,000, and now we're seeing less than, well, anything above 20 is high. So the liquidity's dropped off drastically. So volatility will pick up. So to determine whether a market is in a bull or bear condition is an unfair um, statement to make.